Boston Market. In the mid to late 1990s, there were many things that were in their prime. Michael Jordan was airborne a lot, New York City apartments seemed surprisingly spacious, and the internet made strange noises when started. But two that stand out here are TV commercials and Boston Market, both of which the universe would sometimes align, and much like Pavlov's dog, a slowly turning rotisserie chicken captures your attention. Slide in a side of mac and cheese or some meatloaf, and you might be wondering why this home-cooked style restaurant chain hasn't taken over the world. If you're a fan of Boston Market, there is still hope. If you're a fan of 90s internet, then this is for you. Boston Market started out called Boston Chicken in 1985, a single location started by Arthur Coors and his friend Stephen Colo. Their concept was to bring simple everyday food to the masses and tap into the trend of gourmet shopping that Coors said he had seen having worked in the gourmet restaurant industry. This simple approach to food would involve chicken that had marinated for 24 hours and slowly turned on brick-fired rotisseries. There would be the addition of mashed potatoes, sweet cornbread and various sides, some of which would be the green ones your doctor talks about. Add in some soup from homemade recipes and you can see the appeal, and many people did, with long lines forming. You never know who might be standing in the queue to eat at your restaurant, and in the case of Boston Chicken in 1988, it was a local businessman named George Nadaff. Nadaff was responsible for opening the first Kentucky Fried Chicken locations in the Boston area, and he liked the food and the concept of Boston Chicken. Within the next year, he had hatched a plan with Coors and Colo, with them selling the rights to Boston Chicken and moving into new executive roles at the newly formed New Boston Chicken Corporation. Arthur Coors would work as head of product development, while Stephen Colo stayed on to manage the original restaurant. It was at this point that Boston Chicken began to grow rather rapidly. By 1991, there was more than 25 locations. A recurring pattern once again appears. This time, local businessmen Scott Beck, Jeffrey Shearer, and Saad Nadir saw the potential and bought a controlling stake in Boston Chicken. These businessmen had previously cut their teeth with Blockbuster, being both successful as franchisees and later as executives of Blockbuster Entertainment Inc. They would take Boston Chicken public. Shares in the company went from $20 to $50 on the same day. The market had faith in the Boston Chicken concept and also the management team. This team had joined Blockbuster when it bought their $100 million business. So to be fair, anyone getting out of the home video rental business in the 1990s with $100 million and into the chicken business is either a genius, lucky, or both. It was in 1991 that Nadir, one of the partners, had first encountered Boston Chicken when his brother was interested in purchasing a franchise in what was then a small sub-20 location chain. Nadir went to scope out this new opportunity, and while undertaking his evaluation, he noticed customers buying large orders to go. Unlike other fast food restaurants, Boston Chicken was tapping into a slightly different market, and when asking customers, it appeared that the restaurant was rivaling grocery stores much more than your typical fast food outlet. Like the original founders, Arthur Coors and Steve Colo, had intended, Boston Chicken was looking for a market segment of its own, with a more premium feel and spinning chickens. If by chance you notice your local Carl's Jr. restaurant morphing into a Boston Chicken restaurant, or vice versa, particularly in California, it was because Carl Karcher Enterprises, that runs Carl Jr.'s, bought a development right to build as many as 300 Boston Chicken locations in Southern California and Sacramento, with the introduction of new menu items in order to adapt to consumer trends and to offer variety. A new name would be in order. In 1995, Boston Chicken became known as Boston Market, probably a nod to the early identification of a restaurant chain to rival grocery stores and markets. A relatively straightforward name change for the company, but now the new name provides more opportunity to sell lots of different options than purely chicken, a bit like a market. Items such as meatloaf, turkey, and ham can now be included. The trading name was now Boston Market, but the corporate name was still Boston Chicken, but would later also change to Boston Market, perhaps when the old stationery ran out. While this new public name didn't hinder the performance of the company, the business's financial state did. A lot of expansion cost money, a great deal of money. Bankruptcy was coming. The next chapter for Boston Chicken was 11. According to an article from the Motley Fool, Boston Chicken operated as a franchisor and was acting more as a finance company than a restaurant restaurant operator. This potentially makes it much more difficult to understand a business's true performance in a situation like this. Rather than going down the route of taking on individual franchisees that have a stake in the quality and performance of their individual store, Boston Market wanted growth as quickly as possible, a business model of rapid expansion rather than a focus on the profitability of the restaurants. And for a short while, the company was a darling of Wall Street. Much of the revenue centered on a number of area developers that put up just 20% of development costs, and Boston Chicken would loan the developers the rest. A steady flow of development fees, royalties that just kept increasing, and rising interest rates on the loans to developers. On the face of it, Boston Chicken was doing well, really well, because the only data that was transparent was revenues. These were on the rise, which in turn inflated the company's earnings. While the accounting was all above board technically, it was unsustainable. The developers were unprofitable, and that's an understatement. They lost $51.3 million in financial year 1994, $148.3 million in 95, and $156.5 million in 96. And Boston Chicken's assets were mostly loans that consisted of $700 million to these developers. These are not paltry numbers, and if it's not sounding enough like a certain subprime mortgage scandal, just know that banks including Merrill Lynch and Morgan Stanley were reportedly underwriting large amounts of debt in the form of bonds. The 90s subprime spinning chicken market was just an appetizer for what was to come a decade later. Needless to say, the bubble popped. Chapter 11 bankruptcy was formal, and the previous management was ousted. The large amount of debt would be restructured where possible, and restaurant locations drastically reduced. The locations that Boston Market had accumulated during its expansion were of value. In pops McDonald's. No clown, the McDonald's Corporation purchased the Boston Market chain for a bargain $173.5 million. It was reported at the time that the price paid was not much more than the value of the land. McDonald's would then convert a number of the locations inherited into Chipotle and Donata's Pizza restaurants, both eateries that McDonald's was operating at the time. Some locations would become McDonald's restaurants, and the rest would continue as Boston Markets. This was a no-brainer at the time for McDonald's, a divvy up of the useful locations for the company, and then it sold the Boston Market chain onto Sun Capital Partners in 2007. During the financial decline of Boston Market, there was pressure on cost saving that often shows up in inconsistency across restaurants. Food quality can suffer, and a focus on sales-related data meant selling even at a loss was going on for far too long. Discounting was prevalent, often in the form of coupons to drive people into restaurants. This does increase traffic, but turning a profit from customers is essential. It just wasn't for Boston Market. The company did make attempts to widen the menu choices. An example of this is the Carver sandwiches, still available today, and sandwiches are popular. The cycle that Boston Market found itself in was one of premium food, like the founders intended, but gaining a reputation for big discounts. These two don't usually mix, and leaves consumers confused about the value they should expect. The job of turning this around now falls on Engage Brands, after acquiring Boston Market in 2020. Engage Brands is a Pennsylvania-based operator of Pizza Hut and Checkers and Rallies. This could be a good move for the future of Boston Market, with an experienced restaurant business committed to a long-term strategy. But you never know intent, and Boston Market started with great intentions, and then they had those intentions bought and sold for parts for the last 20 years. Going forward, the Boston Market brand can still be known for quality. Boston Market should be thriving. Premium fast food is in the ascendancy, and Boston Market should be following a similar trajectory as a Panera Bread in this market. The issue is that the company has lost loyalty. It is no longer in the first few options of choice for many diners in the same way that the competition is. Serve quality and reward the people for coming back. Enticing customers back with what Boston Market knows best, chicken. This is a good start. The company launched a Nashville hot crispy chicken sandwich and a Nashville hot rotisserie chicken meal. The people of Nashville, I'm sure, are pleased with the commercialization of their local cuisine. But that aside, it works. Like an implied seal of approval. It's not like you're going to ring someone in Nashville to check its authenticity. Chick-fil-A and Popeyes are big players in this market, well established, with strong customer loyalty. When people are thinking about chicken, this is who you have to beat. They're well known for a reason. One area identified for growth is an express version of Boston Market. This is a scaled down footprint of about half the size of a traditional Boston Market restaurant, a trend that many are moving towards. Less costs for a smaller unit, less resources involved to open a new location. A slight move away from the previous strategy, but a strategy of growth nonetheless. This means more expansion, more locations, quickly. We've been here before, but maybe this time things are different. Maybe. The 90s might be over, Jordan may be retired, your rental copy of Space Jam should probably have gone back by now, and subprime chicken derivatives are hopefully all in the past. Chicken is still popular, more than ever. The company that has been bought and sold more times than a multi-million-dollar convertible debt offering financial instrument is still going, and you can even order your Nashville hot crispy chicken sandwich online. All things Boston Market or Boston Chicken. Let me know. Thanks for watching.